Good afternoon. Thank you for joining. My name is Michael Wright with Foresight Wealth Advisory. Today, we're going to walk through something that most business owners don't fully see until later, how taxes impact not just your income today, but your retirement and ultimately your family. We're specifically going to discuss a solo 401k tax strategy for solo entrepreneurs such as independent contractors, consultants, real estate professionals, doctors, anyone that has basically a one person business with no employees. What we'll cover today is taxes, retirement income, estate impact, contributions by entity, the Roth 401k, and the pre tax or traditional 401k. I am Michael Wright with Foresight Wealth Advisory. I have 35 plus years of experience in business and finance to help people grow their assets and, most importantly, to keep them secure for living comfortably and leaving a legacy to future generations. I have 23 years of experience in the investment and financial planning industry. I was a certified financial planner for 10 years. I left the industry about 11 years ago to focus on uh, my family and also to have some other businesses. One included, and what I primarily have been doing is helping small business obtain uh, capital and working capital to get through cash flow crunches and to help scale their businesses so that they can build their most important asset. In January of 2026, this year, I started an independent registered investment advisory firm registered in the state of Indiana so that I can help people build their wealth and pass it on to their families. There are three tax phases today: the earning years, retirement, withdrawals, estate, which is the transfer to heirs. The solo 401k can be a very important tool for solopreneurs. You can save up to, or you can contribute up to $75,000 annually, 83,250 between the ages of 63. And there's some other catch-ups contributions you can do, and it just depends on your age and your income. You can use either a pre-tax or traditional 401k or a Roth 401k. The key decision is whether you want to pay taxes now or it's best to pay those taxes later. We can also add cash balance plans for more contributions if you have a higher income level than the solo 401k can help you with. Solo 401k generally is a very inexpensive plan to administer, and it's very flexible in what you can invest in depending on which plan. Here are the contribution differences by entity. If you're sole proprietor or single member LLC, basically, if you have a Schedule C, you can put up to 100% of your compensation as an employee, and you're limited to the annual max. The employer can contribute 20% of net self-employment income, which is net earnings minus 50% of the self-employment tax. If you file as an S Corp or C Corp and you get a W-2, you get up to 100% of your W-2 wages, limited to the annual max, and the employer can contribute 25% of W-2 wages. If you're set up as a partnership, multi-member LLC, which really doesn't apply to the solo, but we'll read it off anyway. Employer can do 100%. Employee can do 100% of compensation, 20% of net earnings from self-employment, as is reported on Schedule K1, adjusted for 50% of self-employment tax. Overview. And this is basically a case study. We had a client, and he was kind of amazed that he hadn't heard of this or done this before. So that's why we're doing this video. He's a single filer with two adult children. He's 57 years old. Annual income is $250,000. He's wanting to contribute $75,000 a year. And he doesn't really plan on retiring. So he plans on contributing for 10 years until he's full Social Security age. And then, he may contribute or not. But this is, what we're going to illustrate for you today. He isn't planning on retiring, not worried about risk. So we're going to show a 9% average annual return. And in 10 years, he will withdraw 150,000 a year for 20 years. A Roth 401k versus a traditional 401k summary. In the working years, you would pay $240,000 in taxes on the contributions to the plan. If you chose to use a traditional solo 401k, you would save money on taxes today. At retirement, if you had the Roth, you would pay zero taxes if you withdraw that $150,000 for 20 years. If you use a traditional plan at retirement, we estimate it would be $660,000. And this is for illustration purposes, based on today's tax rates and our best guess of what his tax bracket might be. Your net retirement income under a Roth would be tax-free. It's taxable under a traditional plan. The estate value to your heirs on the Roth, they would receive $4.7 million. So those two children would split that up. And if we have the pre-tax plan, then you pass away, they'll have to pay taxes over a 10-year period. So they'll get 2.9 million, and the tax impact to them would be $1.8 million. If they use a Roth, it would be zero. So the accumulation and tax impact of pre-tax contributions are a $75,000 contribution. You'd be able to deduct that off your taxes, giving you an immediate tax break of $24,000 a year, and we're assuming a 32% rate. So you'd have total contributions of $750,000. We estimate the value at retirement be $2.34 million. Your Roth contribution, if you did a Roth, it'd be $75,000 a year, and you'd have no deduction. You pay taxes on all of it. So if you reinvest your pre-tax contribution savings, so that $24,000 that you saved in taxes, we put that in a 9%. And some investment that would average 9% a year for 10 years, that value would be $365,000. And the after-tax value of the side account would be $290,000 if you paid capital gains taxes, if you took it all out at once. On the pre-tax contribution retirement withdrawals, we're assuming he withdraws $150,000 a year. If it was a Roth, he would have no taxes. But since it's not, we're estimating, because he has lower income, there'd be 22% effective rate. So he'd pay $33,000 of taxes a year at retirement, and he would take $3 million in total withdrawals, and the taxes would be $660,000 over that 20-year period. Roth retirement withdrawals, $150,000 a year, no taxes, and you get $3 million out tax free. So as you can say, the taxes paid. So for the next 10 years, it'll be a little bit over 200,000 on the Roth pre-tax. It's like 650 or whatever we said earlier. I apologize. And for this gentleman, this is what we're planning to do with him, because he has You can use a Roth 401k, and you can also use pre-tax contributions in varying years depending on the income that your business has. So in some years, our client is showing large losses. He really doesn't want to pay taxes. So when we were discussing this concept, he was excited about, hey, I can take $75,000. I can save like 20 grand a year in taxes over 10 years. That's a $250,000. Um, which is that's a great idea. But then we showed him, it's like, well, when you take it out, it might be better to do a Roth. So what we did was a blended strategy. So in the years he purchased equipment and he has losses, we decided we'll do the Roth IRA. And then the years where he's showing big income, we're going to reduce that income tax by contributing to a traditional solo 401k. So we can adapt this to either business cycles or, purchasing. In his case, he has a business where he'll purchase, large equipment and show pretty big losses. And it creates tax diversification. One thing to note on this slide is, um, you know, pre-tax contributions to retirement plan for a solo business owner. You can't push those forward. You can't roll them into future years if you have extra. So when should you use each strategy? In the low income years, you can use a Roth. High income years, you can use the pre-tax to save money on taxes. And then you can reinvest the tax savings when those funds are available. So on this blended strategy, the total portfolio would be 2.34 million. You'd have 1.17 in a Roth, 1.17 in a pre-tax account. That's all taxable when it comes out. So the withdrawal strategy, you'd still take the same 150,000, but you'd take 75,000 from the Roth, 75,000 from the pre-tax account, and your estimated tax would drop down to 16,500. So it's basically half the taxes when you take it out. Now, just like we mentioned before, depending on your overall situation, if you have a lot of taxable accounts, um, and 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 you want to time that with Social Security and other things, with some planning, what you can do is allow the Roth to grow, um, and take out pre-tax at certain times so it's taxable, um, or in years that it makes sense, you might want to cash in gains for, where your after tax accounts, you're getting capital gain rates, um, and then hold off on the traditional withdrawals until later down the line. So this type of plan, even though they're overall numbers, Roth always sounds better, usually when you're spreadsheeting it out. But again, it really depends on your business, the ups and downs of your business, and whether it makes sense to take reduce taxes today or tomorrow. And there's a lot of flexibility you can use with these plans if you have a good plan and you update it every year. So the estate outcome, um, with your Roth, you have 4.7 million, or with the blend, the Roth, you'd have 4.7 million, pre-tax 2.9, taxes paid would be 1.8. The blended outcome is you have 4.7. If you have the Roth, it's all tax free. Pre-tax gross is 4.7. Taxes to the heirs is 1.8, and your net would be 2.9 million to your heirs. Here's this in a chart. So your heirs will get a lot more if you're willing to pay the taxes now and sacrifice for them. So if you had two children, basically you're taking the 4.7 million, you split in half. They have to take this out in 10 years. So you get 235K a year in withdrawals. With the Roth, they're getting up close to 2.5 million pre-tax. They're getting 1.5. Oh, here it is. 1.5. 50/50 blend, they're getting 1.9, and 100% Roth, 2.35 tax free. If you have a spouse, this gentleman was, yeah, he's single with two adult children. But if you do have a spouse, they're entitled to like a lifetime stretch. So whether it's a Roth or another or a traditional, um, they have more, they can stretch it out over their life expectancy based on the IRS RMD tables. As you can see, they pay a lot less taxes as a spousal IRA versus an inherited IRA. So the key takeaways are that taxes impact every phase, the structure of business and the structure of your retirement plan determines the outcomes. Planning can greatly affect your family. The next steps are, review your current plan and think out your goals and how you want things to work out. And it might make sense if your business needs, funds now, might make sense to, write off the taxes now and pay more taxes later. Um, you optimize your tax strategy for max net assets. So it's not always, the Roth looks really good on paper, but as you know, if you're running a business and you need capital now, it might be best to take the tax savings and defer the income taxes till later. So, the best idea is just have a really good plan, coordinate your tax, your retirement, and your estate, and just so that you can see the clear picture before you choose your options. So thank you very much for attending today's webinar. This has been Michael Wright with Foresight Wealth Advisory. Have a great day.